In the last video, we talked about why smart investors still get burned by tax advantage deals, not because they're careless, but because they're trained to focus on the wrong signals. In this video, we're going to talk about where these deals actually break. Not in theory, not in marketing decks, but in practice, under scrutiny. Because most tax advantage deals don't fail loudly. They fail quietly, structurally, and often years later. And by the time that happens, capital is already committed, assumptions are already baked in, and the cost of being wrong is much higher than anyone anticipated at the outset. What makes these failures especially frustrating is that, on the surface, nothing about the deal looked obviously flawed. The documents were clean, the explanation sounded reasonable, the professionals involved appeared credible, but the problems weren't visible at the surface level. They lived in the structure, in the incentives, and in the quiet places most investors were never taught to examine. Most fragile deals are sold tax first and structure second. The conversation starts with the size of the deduction, the timing of the write-off, and the percentage of income it offsets. That framing immediately conditions investors to evaluate outcomes before they understand mechanics. It creates the impression that diligence is about magnitude rather than durability. What's usually missing from that pitch is a clear explanation of how value is actually created, who controls pricing and execution, and where economic risk truly lives. Instead, investors are encouraged to assume that structure has already been handled for them. There are lawyers involved, there are accountants involved, there are appraisals involved, so it must be sound. But documentation is not the same thing as defensibility. A deal can be documented thoroughly and still collapse when its assumptions are challenged. The presence of professionals doesn't guarantee that incentives are aligned or that economic reality supports the tax outcome being claimed. It just means the deal has been packaged competently. One of the most common structural failure points we see involves related party transactions. These deals often look clean on paper. An investor acquires an asset at a discount. That asset is then donated or contributed at a much higher claimed market value. The recipient entity is tied to the sponsor, either economically, operationally, or contractually. The difference between the discounted purchase price and the inflated valuation becomes the tax benefit. On paper, everything appears to check out. The steps are documented, the valuation is supported by an appraisal, the charitable or recipient entity exists. But in reality, it's a closed loop. There's no true market discovery. The price isn't established by independent buyers negotiating at arm's length. It's assigned within a system where the sponsor influences the asset, the valuation, the buyer, and the recipient. The IRS doesn't oppose charitable deductions. It opposes self-referential pricing. When all sides of the transaction are economically linked, fair market value stops being a fact and becomes a story. And stories don't hold up under adversarial review. At that point, the investor isn't participating in real economic activity. They're participating in a valuation narrative. And valuation narratives tend to collapse when examined closely. This is where appraisals are often misunderstood. An appraisal doesn't create value, it attempts to measure value. When valuations rely on projections instead of transactions, assumptions instead of buyers, or proprietary methodologies instead of observable markets, they become fragile. That fragility increases dramatically when the appraiser is relying on inputs provided by the sponsor rather than independent market data. An appraisal can support a real transaction that occurred in an open market. It cannot justify a manufactured one. If the underlying structure fails independence tests, the appraisal fails with it. Paper defensibility and audit survivability are not the same thing, and investors who confuse the two often don't realize it until much later, when the cost of unwinding the position is far higher than the perceived benefit at entry. Another area that gets overlooked far too often is how the sponsor gets paid. This is one of the simplest diligence questions an investor can ask, and one of the most revealing. Does the sponsor win only if the investors win, or does the sponsor get paid regardless of outcomes? We've seen many structures where fees are front-loaded, economics are back-ended, and risk is shifted almost entirely to the investor. In those cases, the sponsor is monetizing participation, not performance. It's not alignment, it's extraction. The strongest deals align incentives over time, ensuring that the sponsor's success is tied to the investor's success. The weakest ones monetize the moment capital is committed, long before results are known. When these structures fail, they rarely fail all at once. More often, they unravel through recharacterization of deductions, disallowance of valuation assumptions, timing mismatches, or loss of intended tax treatment. Sometimes the tax benefit disappears entirely, sometimes it reverses, sometimes it creates penalties on top of loss deductions, and none of that risk is reflected in the original pro forma, because pro formas don't model scrutiny, they model best case assumptions. Good intentions don't survive audits, economic reality does. And when economic reality diverges from the story that justified the tax benefit, the structure collapses under its own weight. In the next video, we're going to address one of the most misunderstood and most abused areas of tax advantage investing, material participation. We'll talk about why it's far harder to substantiate than people are told, why syndicated structures struggle here, and why you cannot paper your way into active losses. Because the strongest tax strategies don't rely on assumptions, they rely on control, economics, and reality.